Labas rytas. Good morning, everyone. So I need to take just a moment to thank our sponsors and our Lithuanian attendees here. Dėkingas. Mano vardas Rimas Kapeskas, nes aš gimiau Jungtinės Amerikos valstybėje, mano tėvai abudu gimė čia Lietuvoje, tėvas Ukmergėje ir mama Kaune. Ir visada nuo pat mažens aš žinojau, kad aš esu lietuvis. Nes čia tik tai trečią sykį esu aplankyti Lietuvą, bet kas sykį tai įspūdis toks didesnis ir didesnis, kad čia jaučiasi kaip namo. Tai dėl to pakvietimą čia kalbėti šiandien ir būti su jumis, tai labai ačiū, dėkingas. All right, so I would have been remiss if I didn't thank our hosts. I'm a little bit of a hybrid, and I'll explain. I was born in the States, raised there, but my parents are both Lithuanian. So we were raised in a very strong Lithuanian culture, and I can really identify with that. And when I'm here visiting, even though it's only my third time here in Lithuania, it feels very much like home. So it's an interesting experience for me to be here today, and I'm grateful. Okay, so today's topic, we're going to talk about the changing landscape of raising seed venture capital. I'll explain why I'm talking about this in just a moment, but I wanted to show you something first. Has anybody ever seen this before? It is the coolest. Have you ever gotten up one day and seen something and said, wow, I wish I had thought of that? We'll get back to this in a minute, okay? So we're going to talk about funding first. I am by profession a venture capitalist. And I'm, again, a hybrid. I am a corporate venture capitalist, which is a little bit different from normal venture capital. I work for a large corporation. You may have heard of UPS. We're a large global transport company with over 400,000 employees, over 100,000 vehicles, trucks, motorcycles, lots of airplanes. We've got the 8th largest airline in the world. And we also have a venture capital fund, which is my job. I get to manage that, and it's, for me, the best job in the company. Because I get to work with a lot of startups, a lot of very smart and interesting people with a lot of enthusiasm. But why do we do that? We do that because we want to learn about new technologies, new business models, and really understand what's happening so that we can see what the future is going to look like and hopefully make better business decisions. My company was a startup too, 108 years ago. But it was a startup, started by 2 teenagers who borrowed $100 and opened up a little shop in a basement in Seattle, Washington, back in the States. And now we're a global company in over 200 countries and doing quite well with a valuation over 100 billion. But it takes a while to get to be a unicorn, but that's changing now too. So that's what I want to talk about. With the changes in technology and the speed of things changing at Moore's Law plus, it's really important to think about how you're going to build your company and how you're going to be successful and how you're going to hopefully hold on to your company too. So we'll talk about the funding and how you get to exit here. Yesterday I spoke to a group of executives, CEOs, CTOs from larger, more mature companies, and I took the time to explain to them why they should be paying attention to startups. If they want to be successful and be around in the future, they need to see what startup companies are doing and the type of innovation that is resulting from the technology and everything else is coming at us so much faster and faster. Because when you're running a larger company, a successful company, you can get very focused on what you're doing today and not pay attention to what's out there in the future that you should be paying more attention to. As entrepreneurs, you naturally think more about the future and try to understand what's happening. And I try to tie the concept together, and I'll go through this quickly, but never before in human history have we seen a better mesh of creativity and technology happening at this type of amount, speed, and pace. It's just amazing what's capable and what's happening. And all of that's changing us. It's changing our human behavior. I gave some examples about how you have to pay attention to what customers, consumers, people are doing in general, how they're behaving, how they're using technology, how they're changing the way they behave. And we're changing the way we buy things, the way we spend our money, the way we spend our time, the way we learn. Everything's changing very fast. And it's changing businesses. So businesses need to stay in tune with those changes And startups are a great way to understand what's next, okay? So now I get back to the full loop venture capital, and this is why I get to have the fun I do and take a look at the world like this and try to understand human behavior, startup behavior, and how it's going to help make businesses more successful. So, as a startup, you all need help. You're very smart and energetic, but there's going to be times when you're going to need someone to come along and help with your growth and your success. This is the traditional model of how startups usually get started, and this looks at your cash and versus time, and the green line here shows how much money you're going to be spending, okay? And you don't break even at first. You're going to be spending lots of money, and you're going to go to look for money from, well, first you're going to go into debt yourself probably. You'll do a bootstrapping, and you'll put your credit cards all to a maximum debt or whatever you can, and then you're going to go to your friends, your family, okay? And we call it friends, family, and fools. People who are willing to just give you money because they like you or whatever it may be. So that's the usual first place people start. So you'll go through your own money first, and then maybe you'll bring in a co-founder for some more money, and then you'll go to your relatives and others. And then eventually, you start moving up the curve. And now you're starting to talk to angel investors and other people who are trying to understand what you're going to do and see if they can make some money along the way as well. And that's when it starts getting more interesting. And you see things like crowdfunding coming up now. Okay, there's conscious social capital that's becoming bigger and bigger, and there's competitions and prizes and other things now to incent startups to work even harder at getting to that full growth and maturity of the curve here. So this is accelerating as well, and it brings me back to the venture capital piece that I know so well. So the reason I invest in startup companies is because I want my company to make better business decisions, okay? If we have to embrace new technologies and understand them, we'll do some of it in-house. We have an R&D group. I've worked in that group for a number of years prior to taking over our venture fund, and there's only so much you can do inside a company. And what I told the business leaders yesterday is pay attention to startups, because right now, some of the best talent coming out of our universities doesn't want to come work for the big companies like mine anymore. It's kind of boring. We don't have ping pong tables and great coffee machines and all the other stuff that you can get at a startup. So it's good to see what the startups are doing and what they're working on, and they are. They're drawing the top talent of programmers, engineers, marketeers, all kinds of people into startups. So it's important to keep an eye on that. But it's also important to understand who you're picking for your partners when you are launching your company. Who do you want to accept money from? Because eventually you probably will need some from someone. So let's take a look at what's been happening. This is, in the US, the Nasdaq Composite. You may remember the dot-com boom. Back at the beginning of this chart was 2000, when everybody was making everything that was going to change the world. We were talking about disruption, and look how it turned out. Crash down, dot-com bust, and now things are starting to ramp up back again, where this year it's reaching levels that we saw back in the dot-com boom. So it's interesting to see what's happening there, but I'm going to contrast it with one thing. This line here in blue shows venture capital funding over the last 15 years. And it moves around a little bit when you have economic shocks and disruptions, but it does have a downward trend right now. And this is the traditional institutional venture capitalists. So what's happening there, and how's that affecting you if you're trying to start up? This line gets into a lot of details, but the pink line is the important one. That is seed capital, so early stage investing. It wasn't so popular with venture capitalists, and then you started seeing more angels, super angels, and others that were getting together and helping fund interesting companies. And again, we're coming out of an economic downturn, and the technology is getting more and more interesting. Seed investing went way up, and now it's starting to go down again. And we're trying to understand why. Why is that happening? And I'll get into this more in a minute. So what are your options? When it's time to borrow some money, you can go to the bank. Not a bad place to get money if you can pass through the application process and get them to give you some money. It's very difficult as a startup. You've got nothing to show them for a track record. usually they won't give you money unless you don't need it. So you're stuck. Good luck getting money from a bank, and they're going to charge you high interest rates if they give you any. The good thing about it is, though, you're not giving up equity in your company. So start there if you must. It's not a bad place to get money if you can do it. But I'd recommend for anybody starting a company now to read the book Lean Startup. Okay, that is obviously I'm not telling you anything new if you're doing a startup right now. Staying lean, keeping your costs low, cash burn low is the best way to get to success. Okay, and not need other people's capital and not need to give away your equity. But there's also challenges involved with doing that. So other sources of funding may come along, and you should pick your partners carefully. You should understand why you're bringing a partner in, what's their interest, what's their motivation, what is their objective, why would they want to be lending you money or investing in your company, what do they want to achieve? Okay, and what do you want to pick? It's the same as picking a co-founder. You want to pick someone who's going to be thinking the same way as you, and it'll be a good, strong partnership. The last thing you want to do is pick a co-founder and turn out that it's a terrible mistake, okay? If you're going to write up agreements, make sure you write up your exit agreements for you and your co-founders. Should you have a disagreement sometime, you have a way to divide the assets or whatever it may be. It's important to understand that before you start the relationship. So if there is something that goes wrong, at least you can protect what's happening and you've agreed up front what would happen if it goes wrong. But the same thing goes for the types of partners you'll pick for venture investing. So again, I am a corporate VC. Our motivation to invest is different from the institutionals. They just want to make money for their limited partners. So it's a very straightforward objective, but they're going to push you to hurry up and get to a big number valuation so that they can get a high return. It may not be at the same speed that you want to go. They may talk you into taking more money than you needed. Not a bad problem to have. But still, it's not aligning with your objectives and your growth speed that you want to go through all the time. Corporate VCs look at the world differently. We want to learn about what's happening in your ecosystem and try to understand that. So I call corporate venture money patient capital. We're willing to go along for the ride, not interfere, but see what's happening in your sector, in your technology, and learn where that's going. Again, it's kind of an extension of R&D for us, the way we look at it. We don't have to have our own internal R&D resources necessarily working on every technology if we can learn from startup companies and see what they're doing. So we're there to watch and learn and understand. So the money and more of the equity hopefully stays with you and your founders and your partners. The good thing about having a corporate venture partner is the statistics show that the most successful exit is an IPO, okay? Or to get an acquisition at a very good number. Companies that have a corporate venture investor, a strategic investor, are 4 times more likely to get to IPO than companies that do not, okay? So, and a lot of times there'll be multiple strategics. We actually like each other, we talk to each other all the time. Unlike the institutionals, we share ideas and introduce companies to each other all the time because we're all in it for strategic objectives. So we're not competing for the value of the returns. We're really just trying to share ideas and help our companies grow. As long as we're not competitors directly, with the other strategic, then we'll be glad to share ideas and talk about those things. So referrals, if you're trying to get into a corporate VC, okay, my suggestion is don't just cold call them. See if you can find someone who's connected to them first and make an introduction for you. Why should this corporate VC want to talk to you? There's an easier way in that way than just knocking on the door. If you want to do that, you can, but be prepared to think like that corporation. I have a lot of people coming to me to talk about why UPS should invest in their startup. And a lot of times they'll think that because UPS is a big transportation company and they're going to start transporting packages too and do things like us, that we'd want to invest. Well, I've said before, we want to invest to learn about things. We already know about how to transport things around the globe, so I won't invest in someone who's already doing what we already understand very well. We'll look at the adjacencies and technologies that might impact us 2 to 5 years down the road to understand what is it that's going to change in our environment that we could understand better by getting close to a startup. So the way we do that is make an investment, get involved, observe your board, meetings and try to learn from your team as to what you're doing, and we try to assist along the way. So one of the other benefits of corporate venture capital is that the companies in my portfolio can get access to our network. We've got a global network, like I said, 100,000 vehicles, 500 or so jet aircraft. We've got a top-notch list of customers. Pretty much everybody in the world knows who UPS is. And as a portfolio company, you can get certain access to those things that you wouldn't normally be able to get if you're trying to start up yourself. So that's part of the advantage. The expertise, we have a strong engineering base ourselves at UPS. It was built as an engineering company and technology company that happens to have trucks now, but we can offer a lot of guidance and help too. And you get that from traditional VCs as well, but you'll get it more so from a strategic that really wants to understand your business and help you along. So that's one of the benefits of coming in there. There's plenty of other things that companies can learn from startups and startups can learn from companies. So it's always good to kind of see what your match is. It's like I said, it's like picking a co-founder. You want to pick your dance partners, your investors carefully to make sure they're going to be with you the whole time. When we invest in a company, we stay there through their follow-on investments. We like to be a good follow-on serial investor in the company to make sure that they're going to be successful. But the thing that's changing a lot today is there's so many more options out there. Okay, so VC money, you could see from the chart I showed you, the blue line is trending down. Venture capital from corporations is actually going up. My company started a venture capital fund back in 1997, just when a dot-com boom was taking off. We realized that there was going to be a change in the marketplace, change that would impact our industry. And it basically, the word was not coined yet, but it was called e-commerce. We wanted to understand e-commerce and make sure we could adapt to it. And by watching the early startups during the dot-com boom, we learned how to get into shopping cart technologies and everything else that was coming along with e-commerce and now mobile commerce, social commerce. We still are learning and trying to understand that. But as a result, we've got a good market share of everything that is transported after it's bought. When it's physical goods that gets bought online, you're not going to a store to get it. We're probably bringing it to you. So that was the benefit we got by understanding that shift. But today, there's other ways you can get your product to market. And one particular one that is an alternative now that's interesting is crowdfunding. And it really is interesting because you get another means of great access to free marketing and access to customers. And you can raise a lot of money if you've got the right product or service. People are willing to give you money in advance, sometimes years in advance, to help you fund your idea so they can get an early version of it. It still today blows my mind how much money some products make. So I showed this one earlier. This is called the coolest cooler, and I wish I had thought of this. This is a cooler, but it's actually a party disguised as a cooler. This thing has solar power. It can run a blender and make drinks for you. It's got a music system in there and speakers that are recharged by solar power. It does so many things that if you're going out with your friends to the beach or wherever it may be, this is what you want to have with you. But what's really remarkable about this is, on Kickstarter, it was the #1 campaign. It had over 62,000 backers give some money to get on the list to get one of these when they first come out of production. They raised over $13.3 million in a matter of months. So when you're trying to think about your product and how you're going to get money to make it and get it out into the marketplace, that's a pretty interesting story to be able to come up with $13 million just by promising people a cool product. So this is new. It's only been around for a few years, these Kickstarters, Indiegogos, but for people who have a consumer type of product that's interesting, that's a great way to go. Another thing to think about if you're trying to look for investors is, what kind of startup are you? Okay, if it's not a cool product, maybe it's something else. So one of the questions you can think about is, who cares about what we're doing as a startup? So a lot of times I see a lot of pitches, a lot of business plans, and I call them first world solutions. So do I really need to have my pizza delivered in 15 minutes as opposed to 30 minutes? Maybe, but is that really going to make my life better or improve anything in the world? I don't know. But the people who are doing the social impact investing, that's what they care about. Okay, they want to help the world be a better place. There are problems out there. There's people who are hungry, people who can't get clean drinking water, and the world is kind of turned upside down. as far as how people live, and it's not equal around the world. So people who do social impact investing are actually deploying a lot of money for a purpose that they know will make the world a better place. They want to feel good. These are people who usually have made a lot of money. Bill Gates Foundation is one of the largest. So Bill and Melinda Gates are helping solve problems all around the world, and their money goes towards things where they're not as concerned about the financial return of those investments. What they care about is that it will build a sustainable, successful business. So the types of things they're funding are things that should become self-funding eventually, just like you want to do with your startup. Okay, you want to become successful. In the past, too much money has gone to things like humanitarian aid, bringing food into countries where people are starving, and it actually does the wrong thing. It kills the market for the local farmers. They don't have a way to sell their food to the markets if free food is coming in as relief. So what has been learned by the people on the social concern side is that you have to help business and entrepreneurs build their business. That's why so much money from social capital now is going to good causes, not just to help feed people, but show them how to feed themselves. So that's another way to think about your launch and what you're doing if there's a social cause involved. You're all competing with other startups, but there's something new now happening that is getting bigger and bigger as well in the competition space. So there's all kinds of competitions out there. You can get some money by participating in a pitch competition like this here too, but there's even bigger things like the XPrize, the Ansari XPrize. Millions of dollars going towards a big, big cause. Things that are trying to change the whole world or the way we think about the world and accelerate a path there. So these are another interesting way of raising capital for a startup, and it's actually getting a new type of entrepreneur involved. So there's a type of people that are entrepreneurs like many of you, and there's others who are just like really super, super smart scientists. I meet people like this regularly, but they're not the type that are going to go start a company, so they don't even think about that. Well, now with these types of contests, suddenly they're starting to think about what's it going to take to become an entrepreneur and take those great skills that they have, the things that they're thinking about, the things they think they can build and make the world a different place with these prizes. So this is having an impact too, and I'll show you in a second what that's looking like. But there's plenty of these things happening here around Europe. Okay, I know I participate in the World Economic Forum Technology Pioneers Program, and we judge companies around Europe as well and around the world to see who's really going to be changing technology in a way that's going to be very positive. But there's a whole list of other competitions available throughout Europe, throughout the US, and I encourage everyone to take a look to see which one of those are a fit for your startup. So I'm going to get close to wrapping up here and allow for a few questions, but I wanted to show one thing here. I started with this slide about venture capital money going down, and it is from the traditional institutional VCs, but there's some other things happening right now. This is the corporate venture money coming in, and it scale-wise does not look like that much, but it actually has doubled in the last 5 years. So there was over $5 billion last year deployed from corporate venture capital firms. We now have 1,200 or more companies that are officially doing corporate venturing. When my company started doing it, there was only about 50, okay, back in late 1990s. So it's getting much more popular. More corporations are figuring out that they want to be involved in this. And again, their motives are pretty straightforward with what they're trying to learn and do a lot of times. Okay, so another great place to see where there's some additional money coming in addition to the blue line. So this is not part of the blue line, this is an addition. The other one we talked about was crowdfunding. So the Kickstarters, Indiegogos of the world. It's amazing how much in just a few short years, those are really starting to contribute to how much capital can be raised. We talked about impact investing, social investing, I call that conscious capital. Another big area, really starting to hit home right now with a lot more. And then lastly, the competitions. So the numbers on the chart here only go through 2013. I tried to get numbers on all of these for 2014, and they're not all officially published yet, but the lines did cross last year. So there's now more money coming from these for other sources for capital for startups, and they're all looking earlier and earlier than they would have before for good companies. But this is an indication to you that things are changing even in the capital markets, and people are looking for interesting ways to deploy money to startups. So going forward, we'll see what happens. The traditional VCs are going to continue to do well, but think about these other four sources of capital, because I think it could be interesting for you and your company to take that into account. And that's it for what I wanted to mention here. I'll say thank you now, Achu, and if there's any questions, I can open it up for that as well. No questions? All right. Well, good luck with your ventures. I hope you are able to raise all the money you need and are a big success. And we'll see you in the newspapers when you're a big hit and you're a unicorn. Thank you very much.